Sponsors are looking for growth. They're looking for yield. Many are looking to the middle and lower middle market for these opportunities. So not only alongside an uptick in co-investments, we are seeing as well an uptick in activity in this pocket of the market. Likewise, much of the co-investment activity seems to be flourishing in the middle market as well. Traditionally, passive investors are pretty hungry to be active, and on the flip side, you've got sponsors that are eager to smooth, facilitate, and understand how best to co-invest. Now, this is a kind of art. It certainly takes finesse, but it does open all kinds of doors to hopefully new capital, new relationships, and successful investments. About a decade ago, I'd say that this dynamic didn't exist, and while co-investments have been around for a while, it's certainly not with the kind of fury that I think we've been seeing of late. So as we navigate the waters of co-investments, we've got risks, we've got rewards, and we've got all sorts of challenges that continue to surface and evolve. In a recent study conducted by Pepper Hamilton and Mergermarket, we surveyed 50 private equity executives on the co-investment landscape in 2015. Several key benefits to these types of investments were identified. These include, number one, the dispersal of risk. Number two, the ability to tap into new pools of capital. And number three, access to expertise. But on the flip side of that, there were also key concerns that surfaced, namely regulatory scrutiny, transaction fees, and possible misalignment on terms between co-investors and sponsors, particularly as it relates to exits. I'm sure Bruce will do a little bit more digging onto the details of that study, but for what it's worth, we aim to tackle as many of these key findings today with our panel of experts. So with that, I would like to introduce our speakers. Number one, we have Julia Corelli on the line. She co-chairs Pepper's Funds Services Group and Commercial Department, currently serves as vice chair of its executive chairman. We've got Bruce Fenton on the line. He is chair of Pepper's Private Equity Practice Group as well as Investment Funds Industry Group. We've got Jason Mundt, principal of Siguler Guff, who is actively involved in manager selection, due diligence, and direct investment for the firm's Small Buyout Opportunities Fund. Michael Reinard, who is investor relations consultant for PeakEquity Partners. He leads investor relations efforts at PeakEquity, which is focused on one of those key markets, lower middle market investment. And then we lastly have John Shoemaker. He is managing partner of Milestone Partners. Milestone also focuses on the lower middle market private equity universe, specializing in controlled equity investments. So with that, I will hand it over to Bruce.
Thanks very much, Claudia. Hi, everyone. What we're going to do first is just talk a little about co-investments generally, and then plunge into the survey. In the a couple of pages beyond Brian, on page 19, we've got a little summary of the state of play of co-investments in 2015. As you can see from the slide, our survey shows that 56% of GPs look for co-investment opportunities from the outset. 62% indicate that the majority of co-investors came from existing LPs, and 18% of co-investors were referrals from LPs. So you've got GPs really focusing on co-investment as a key element of their investment strategy, and LPs, existing LPs, are a key element of finding that co-investment money, and either because the dollars are coming directly from those existing LPs, or because the co-investors were referred by those LPs. So if you had 62 and 18, you're talking about virtually 80% of co-investment dollars are either directly or direct referrals from the existing LP pool. So, Brian, let's move to page 21. if we can, and jump into our first major slide. So, John Shoemaker, we're going to start with you after we look at this slide in a little more detail. The slide talks about the extent to which funds offered the opportunity to LPs to co-invest. And as you can see, 100% of funds offered co-investment opportunities to limited partners. The largest responders, 56%, actively explored investment opportunities. 42% offered them on an opportunistic basis, and 2% of funds, all investments closed had co-investment opportunities. But what that really means is that all funds are very seriously keeping in mind co-investment opportunities, either opportunistically or more vigorously. John, what's your experience in that, and ultimately, how does it play out in terms of the number of opportunities that you have, that whether you offer the opportunity or not, they ultimately wind up closing with co-investment?
Yeah, thanks, Bruce. I would say we're in that category, close to the 2%, that just about all of our deals end up with some form of co-investment. And I think it's fair to say that we're probably actively looking for opportunities that will allow us to bring co-investment opportunities or LPs. I think that's something that's expected in the current environment, that particularly in the lower middle market or middle market, that the expectation from the investors is that there are going to be substantial opportunities for them to deploy additional capital within your deals. And and I think it's not just implicit, it's explicit. 10, 20 years ago, I think it was implicit that they'd like to look at opportunities, but I think that now they're not only being explicit about it, but they're actually built, and a lot of your LPs have groups that really focus on those co-investments, so they're able to respond quicker. I would, in our deals, back to the slide 19, we ran some numbers here at Milestone for this call, and we basically came out and said about on our average deal, and this sort of speaks to the fact that we're constantly looking to deploy a little bit more than our sort of average check size in a deal. We're a $300 million fund, and our average check size is probably in that $20 to $25 million range, implying sort of 10 deals or around that amount. So we've, on average, provided about 50% of the equity for the transactions that we've led. And remember, we're a lead buyout shop, so pretty much all our deals, or most of our deals, the vast majority of our deals, we're the lead private equity group. So we are controlling the co-investment opportunities in most of our deals. So about 50% of the equity has come from Milestone Partners on average, and that's been as little as 20% of the equity, but it is that as much as 80 or 90% of the equity, because you always generally have some management rollover. So 50% comes from Milestone. So about 40%, the average of management rollover is about 10%. So 40% is really co-investment dollars. And it really, from our experience, it's been sort of split 50-50 between our LPs and other LPs. Very few of those co-investment non-LP co-investment have come from LP referrals in our case. We built up a rather large database. We have one partner internally who manages that, so we know exactly what our LPs are looking for, and then what other LPs or other family offices or people who aren't LPs of ours are looking for in co-investments, sort of backfill the excess. And a lot of this, sort of how we manage it, and sort of our goal is sort of looking to punch a little bit above our weight so we can provide our investors with co-invest. It comes a little bit from our heritage as a fundless sponsor back in the 90s and early 2000s. We're sort of comfortable in that environment, and I think a lot of our investors backed us because they thought there'd be some opportunities down the road to invest alongside of us.
If we can, Brian, if we can jump forward to slide 24 and kind of segue from something John just said. Punching above your weight is not exactly one of the responses in slide 24, but to maybe put that in a different context, the opportunity to buy a bigger company and be able to do that with co-investors does, I think, fall into the risk-sharing category. It may not be precisely for risk-sharing purposes, John, but it does enable you to not concentrate your investment dollars quite so closely.
Yeah, and I think that's a very fair point, because sometimes it's risk sharing because you don't want to have your fund exposed to any one industry, even though you may have a cap of 10 or 15% in any one investment, or even a 10% cap, because you don't want to be, your investors are expecting you to have a certain number of deals. You may actually want to cap your risk in a certain industry and maybe looking to only put 15 to 20 million in the deal. So you're right, there is a big risk-sharing component, whether it's mandated through your LP agreement or just something you impose on yourself as an industry-specific issue.
Yeah, so to expand the conversation a little, let's stay with slide 24 and maybe bring Mike and Jason in. The other big drivers today of PE co-investment, in addition to which I love, punching above your weight. You've got the risk sharing at 26%, but to facilitate fundraising and obtain capital commitments from investors is the next big one at 22%. Investor strategic alignment with PE portfolio companies at 16%, and then the other big ones are gaining operating partners, establishing relationships with other PE firms, build relationship and goodwill with investors, and fund sponsor drive to remain competitive through differentiation. Mike and John, how important are these other drivers to you? And then Jason, on the LP side, what are you looking for in terms of both your decision to create relationships with the GP to begin with, or on a standalone basis, on what are your drivers for actually doing co-investments as an LP co-investor?
This is Mike at PeakEquity. You know, no doubt that building relationships is a huge component of why we seek investments that have co-investment potential. We're a new organization. We've completed 2 investments to date. Both of them have had a significant amount of co-investment, and that was a great way to get to know a lot of potential limited partners out there by giving them a call, you know, asking them what they thought about a deal, going down the road with a few of them. And, you know, as we grow our organization, we're going to need more relationships like this. So, you know, building limited partner relationships is really key for us, especially for a new young organization. And
Jason, on your end, can you give us the LP perspective on both? You know, the extent to which the funds you invest in are offering you opportunities, and what the drivers are for you in deciding to make those investments or not?
Sure. So this is Jason Mundt with Siguler Guff. You know, we run a fund of funds that has about 40% allocation to co-investments from our investors, and so it's a significant portion of our business. We do make fund investments with GP in funds that we think are just standalone good investments, and actually every investment we make is a standalone good investment. But there are cases where we do know that some funds and managers will throw off a significant amount of co-invest. You know, in the past 2 years, we've looked at about 300 deals on the co-investment side, and those have been from about 250 plus sources, and we've done 87 deals with 45 managers over the last about 8 or 9 years. So it's important to us, it's significant, and part of the reason is that we think we can add value both on the investment decision, and you know, we've seen outperformance from our co-investments, so that is a good thing for our investors as well. And it's also a way to, we think, add value to the manager and to the companies in that we have seen a significant ability for GPs to build bigger businesses, and we do realize that our additional equity capital can help build those.
And I would reiterate that, I think that, we have done co-investments with Siguler Guff, and they do add value. And Jason's actually called me specifically on other deals that other GPs have done where he's calling us looking for help for that company, even in some cases where we actually bid on the same business. So they will work hard. And so if you look at this chart, once you've determined there needs to be some risk sharing in a deal, meaning whether it's mandated or you just decide, okay, it's a $50 million investment, you want to put 25, and you determine there's going to be a $25 million co-investment, we will sit down, and there are a couple things that we'll look at. Number one is, is there a value-added investor that we can bring to the table to help drive this deal and make it a better deal for our LPs? And that's independent of whether they're one of your own LPs or they're another LP or if they're just an operating partner, whatever the other category may be. We're determining who's going to be the best positioned, another fund who wants to be a minority investor but can bring some value. The second thing we look at is how would the fit be with our LPs? So it's really building relationships and goodwill of your investors. Assuming you've satisfied or have been able to find someone who's going to be a value-added investor, then you look at your own LP base, and you have to really understand what your LP base is, understand exactly the kind of deals they want to do, and understand exactly the size deals they're looking for, and then we'll use it to build and strengthen our relationships with our investors. Sometimes with like a Siguler Guff, we understand what they're looking for and we know they can add value. So those are those two criteria. The third thing we look at is just LPs that want co-investment, and a lot of it's size-driven. We don't like to have anything contractual in our agreements if we can avoid it, to require showing deals to other people. Third thing is ease of doing business with your own LPs. How responsive are they to the opportunities? Can they get back? Are they dependable to closing? And then finally, we'll go outside to other prospective LPs, and then finally to just other generic sources that we're trying to fill out around, and the other sources have been exhausted. So that's sort of the process we go through internally.
And we've also found at Siguler Guff that we can be helpful to particularly some of our smaller managers, in that they may not be able to write a big enough check. And so when they're talking to the seller of a company, the seller may realize that the check is outsized for the fund, and so they actually need us to step up early in the process before the LOI and either speak to the intermediary or the company, or provide a letter of support saying that we're extremely interested in investing alongside the manager as well as in the company. So we try to be as helpful in any way we can.
Just to stay on this theme, if I can pop in for a second, this is Claudia on the risk sharing theme. John, you mentioned something earlier on regarding the majority of your co-invest, you guys maintain a controlling stake. Curious to throw out there, in the whole idea of risk sharing here, what is the benefit of retaining a controlling stake, and how can you ensure that you're sharing risk if you are controlling a stake?
Hey, John, before you answer that, we've come to the really exciting point of our webinar in which Brian has to give the secret code word for CLE credit.
Yeah, sorry about the interruption, but if you came in a little late, I am giving 4 code words for you to write down for CLE. The first one is just going to be pepper. That's pepper. Thank you.
All right. Sorry, Claudia.
Well, I feel like I'm like on a radio station or something,
Yeah.
I call that later, I'll get like a free album or something.
The fruit basket's on its way.
Yeah, I know that Julie's going to get into terms, but as a control shop, I mean, just thematically, I mean, just sort of philosophically, we want to control the deals we're involved in, whether we effectively own 20% of the stock, or the equity of the company, or we want to control the board, or whether we own 90%. So, you take that to the next step is, it doesn't matter where the equity comes from, we want to have control of the board. And so when you look at the co-investment, sometimes we'll put together the co-investments into a partnership that will control and be able to vote, or if it's maybe another private equity firm who's co-investing with someone, sometimes it's like a Siguler Guff we trust and we feel good about. They can be a direct investor in the company, but we're ultimately going to control the board regardless of the form it takes in terms of the in terms of the ownership of the voting, as long as we control the board. And then the legal terms take care of making sure that everybody's treated fairly in the transaction from a tag-along or a drag-along. Our co-investors are going to be able to, get out when we get out, and are going to be able, on the same terms and have the same opportunities as we are. We treat them typically as though they're investors in our fund. They're people that, are looking to, for us to make the decisions and move forward the deal. They may have some input in it, but we want them to feel as though that, that they're not going to be left out. That the one place that the friction becomes is if there's additional capital needed. If that's defensive capital, if people are going to step up to the plate who are co-investors, whether they're one of our LPs or not, there may you may have to take a harsh position, put your capital ahead of them if you're the one willing to step up and defend the business, and that can put you in a tough position, particularly if it's an existing LP. If they don't step up to the plate, so you have to impose more stringent economic terms on the deal. If it's for a positive add-on acquisition or support growth capital, they decide not to participate. Well, then you have to make sure that you have fair offering, and people have all had the opportunity to invest both ways, though.
Yeah, and
from the co-investor side, in terms of our general stance is we want the lead investor, the GP, leading the deal, and so we're generally comfortable giving them control, and that assumes that a sponsor we know well, that has a long track record, and that we feel comfortable partnering with. In situations where someone might have less experience, or we may end up being 50–60% of the deal, that might change our thoughts there, but we're generally looking to be a partner and be as helpful as we can, but allowing them to lead the deal.
There's a little too much harmony here between John and Jason, so I'm going to try to kind of mix things up a little. If we go to slide 23, John, you were talking about terms, and there's some interesting data. The first thing is, if you go to the fourth highest typical deal term, you've got the drag-along right, John, that you were talking about coming in at 46%. Which I found fascinating, because you would think that most investors like Milestone, John, who wants to control the deal, and drag along is obviously a critical component of determining the timing for exiting the investment. Interestingly, the corresponding right, the minority right that typically goes with that, the tag-along right, is the number one right that deal term that typically applies. And that's at 68%, which is actually dramatically higher than the drag. John, also, you were just talking about almost imposing a pay-to-play type provision on the co-investors if they fail to support the company. The number two deal term is actually the flip side of that, which is the obligation to fund the follow-on investments proportionately, such that the sponsor couldn't take the next round of investment, assuming things are going well, and take economics away from the other co-investors. And then, the middle one is, the third one is more procedural, the separate audit of co-investment vehicles being required, and that's actually something I know Julie will get to in a couple minutes, the regulatory aspect. So let's focus a little, if we can, on this kind of dichotomy between the drag-along and the tag-along rights. The board seat at 38%, we have one board seat for all investors, and at 26%, there's no board seats for co-investors, which obviously would be a strongly sponsor-oriented provision. Yeah, obviously, John and Jason, you guys have done a lot of deals together. You clearly get along. To stir up a little controversy, maybe talk less about necessarily how you two would interact, but more in general. John, have you ever done a deal without a drag? Would you do a deal without a drag?
No, very unlikely. I mean, there may be sort of nuances around the drag, but I mean, we were pretty much all our deals, particularly there's co-investment, there's going to be a drag along, right? We have to have the control, fundamental to control. I mean, there are really two fundamentals to control. One is being able to change management. Two, being able to sell the company and raise capital. So we're going to have, a drag along in almost every one of our deals. This actually numbers really surprised me, which leads me to maybe that there's some more growth capital, venture-oriented people responding in the deal. And on the tag-along side, we have no problem giving our co-investors a right to tag along. It's only fair that it's, that if you're going to force them to, if you're going to drag them along, they got to be able to go out with you. We can't sell our stake. We would never do that to our LPs anyway, but we can't sell our stake and then leave them in the deal. So, I mean, I think, I see both those in almost all of our deals. But and Jason commented, but the obligation to fund the investment is something it's rare. Usually, we would overfund the deal out of the right at the close. Put the extra $10 million or $15 million in capital if you think you're going to have need for it or for a cushion, rather than requiring an investor to post up money like they made an LP commitment. And in fact, I think that's something that most of our co-investors want to be part of the decision making. Do they want to continue to fund a deal in and of itself? And I mentioned that sort of that issue that you come to is if and Jason and I have been at the table where it's like, okay, the company needs a couple $1 million of defensive capital to get through a tough spell. And, are you going to step up to your share, Jason? They have to make a decision in their investment committee. If they say no, if everybody steps up to their share, it doesn't really matter what the terms are, right? You're not really diluting anybody. But if somebody decides not to step up, well, then you have to set a market price, and maybe that's a 3x liquidation preference. It may hurt the other investors who don't participate. You got to encourage them to participate if they're not going to, make it painful. And Jason understands that, and we've had the discussions about that on a number of occasions. But it's rare that we would require capital funding. That's almost like an LP commitment to a fund. So that sort of surprised me that was in there. I don't know, Jason, you may want to comment.
Yeah, on the tag along, I'm surprised that's not higher because that's pretty much a requirement for us. If the GP is going to sell their stake, we want to be able to go along with them. And regarding the drag along, that's one where we often always give that, and the reason is because we are aligning ourselves, and if the manager sees an opportunity to exit or views there's some risk in the future where they need to exit, we're generally not trying to fight that. And the last thing, we wouldn't want to be in a deal where we own 30% and someone just sold 60%. Because then we're not picking our partner. So we'd rather exit at that point. We have had cases where we may have a mutual drag along right, where or an ability to force the manager to sell the company after a certain number of years. And the reason for that is typically that we view either a cyclical industry or investment where we may have a differing view on it down the road, and we all agree that having those rights for everyone is beneficial. In terms of funding the follow-on obligations, we have occasionally committed capital to deals, but it is generally applied to a roll-up strategy where the manager actually looks at us and they're writing a smaller check up front, but they want to know that we're going to be good for the capital and that we're making a decision up front to invest that capital alongside them to do the acquisition strategy. And so those are the cases where we're comfortable with that. But as John mentioned, we generally want to be making the decision, particularly whether it's an up round or a down round, about whether we're putting capital in. And just as much as it might be, as John alluded to before, as hard as it might be to sort of, talk to your investors about putting money into a company that's not doing well, imagine calling money from them into a company that's not doing well when they don't want you to call it. I would imagine that may actually cause a little more heartburn for folks.
Okay. Yeah, that's a very good point. But when you go back to this point, the drag along, tag along, I would tell you, every deal those are symmetrical. They should be symmetrical in most deals. I can see maybe in certain circumstances where somebody just refuses to have a drag along right for whatever reason, some unique deal, well, then you're not going to give them a tag. Maybe that's the other way you go. So well, that's fine. We won't give you a tag along right. We can sell our majority stake in the company and leave you in there. And maybe in a small percentage of cases, 5 to 10%, that surprised me. On the board seat, it depends on who the investor is. Like Jason's on a couple of our boards, and we were comfortable with him. He adds value, and and you just got to pick and choose your spots. I'm not big on fighting on whether if somebody has a stake in the business that's meaningful, and they're going to be accretive to the board meeting, whether they have a board seat or they have the seat if they're just an observer. I am less concerned on that front if I know the person, because I'm just not. I think it's important for them, if they have a significant investment at the table, to hear what's going on. And if they can't make every meeting, that's fine.
Okay.
Yeah, and I'd say that's an important point for us, is that with a lot of relationships, it is a relationship and we have something there. So we're less concerned with the technical legal aspects in terms of really fine-tuning things. We do want to make sure we're protected, and so we do have backstops on the legal terms. But as John mentioned, if I'm an observer on a board, we're generally 10, 20, 30% of the equity. And, it's pretty much assumed that if I have a viewpoint on something or feel strongly that everyone else is likely to hear what I have to say.
Okay, we're going to.
You want that person is a significant investor, and you're going to have to rely on him for either a down round or up round or additional capital or working with financing sources. You want him to be part of the native team that's hearing the story live, and they may have a different opinion. You want to hear what they have to say, because you're going to have to go to them eventually to participate. So I like having that transparency of them being part of the operating of the business at the board level.
John, I asked you guys to disagree, and you guys still have not yet disagreed. So I'm going to do two things. One, I'm going to turn it over to Brian for another one of those super secret CLE words.
Thanks, Bruce. The first word again was pepper, and the second is going to be equity. Equity.
Okay, and then in my last-ditch effort to cause a little controversy between the two of you, I'm going to direct your attention to the far right of the chart on page 23. In my opinion, actually, again, a little surprising that the percentages are as low as they are. I would not expect them to be as high as on the left side of the chart, but where you see reduced carry, reduced management fee free, and then carry free at 34%. Jason, from your perspective, let's take funds that you either have a relationship with, don't have a relationship with, or just from the general industry perspective. Do those percentages surprise you, and if so, why? And if not, why?
The percentages do surprise me quite a bit, because we're generally not paying carry and economics to the manager, and the real reason is that we're often partnering with someone that we've invested with, and so we're coming into the investment as a partner, as someone they need help from, as a friendly investor in the company, and so we generally don't pay fees and carry. We do, on occasion, back groups that might not have a fund or might be more of a fundless sponsor, and those are unique situations, and we think very hard about those, but we want alignment of interest just like we would with a manager that we're invested with, and so there are times that we will offer economics there, but those are probably a little different than what everyone's thinking of, and I'm surprised if there's a lot of GPs charging their LPs carry for existing LPs.
Yeah, and I wonder if this is more of a function of instead of a direct co-investment, perhaps a term related to a co-investment fund. In our case at PeakEquity, our co-investors are limited partners, and they are not paying us any kind of management fee or carry related to the co-investment capital in the deal.
Yeah, but I will tell you that, look, I think that when you look at the reduced management, there just really isn't any management fee on the capital. This is really, you see it, as Jason said, when we were fundless sponsors years ago, that's how we got paid. We got a carry, we got, in the deal, we got, fees. Where I would say that, potentially you see some fee income is, if it's reasonable, the fact that you're putting together a deal with, $60 million of equity and you're doing all the work, that the outside LPs may be willing to pay you their proportional share of the transaction fee that you charge the deal or monitoring fees, but it's always a source of discussion. And of course, you have your fee offset provisions with your existing investors, but you generally, your LPs, they're in the deal for, the non-promoted, co-investment, and you're just not going to get paid on that. I mean, if we invest $600 million and we have a $300 million fund, that meant, that we're essentially, working for free on that capital, but we will charge maybe a reasonable transaction fee, and outsiders are willing to pay that. And, our LPs aren't up in arms if it's a reasonable transaction fee, because they realize that you're typically a smaller fund and you're reducing their management fee costs effectively on the money in the deal. So as long as it's reasonable, they're not going to, put their foot down in a situation. I mean, I think it just comes down to sort of the reasonableness, the size of your fund, the specific circumstances.
Well,
but not carry. I rarely see carry, even with outside co-investors that come in our deal. Not that, Jason, you can comment. I mean, I don't know if you would necessarily care if we had a $50 million deal and we put in 25 and you put in 10 or 15, and all of a sudden we took 10 on the outside and they're willing to pay us a promote. We haven't done that, but if they're willing to pay us a 10% promote, I'm not. I think that would be almost categorized. I'm not sure how that would be categorized, but. I'm not sure if they would even care if we did it. We just haven't done that necessarily.
Yeah, I think unless we weren't getting our full sort of ask on the dollars for the co-invest, I think we'd be okay with that.
Yeah.
And we
as long as you were taken care of.
Exactly.
Guys,
yeah. And
guys,
I think
as long as it's about you and Kevin.
Having failed miserably to get you guys to disagree, I was
trying to disagree with them a little bit.
Yeah, I'm giving up. It's time for our third super secret word from Brian, and then we're going to move over to the regulatory landscape.
That's great. Thanks, Bruce. The third word is going to be Hamilton. So the first was Pepper, second equity, third Hamilton.
Okay, and then, Brian, if we can quickly look at slides 26 and 27. 26 is the biggest challenges to PE co-investments, and 27 is the most important of these challenges. And in both circumstances, regulatory scrutiny is the most concerning by a wide margin. And to talk us through that and to identify some of the thornier issues, I'll turn it over to Julie.
Thanks, Bruce. So if you go to slide 28, we've listed there some of the top regulatory considerations. And when people are thinking about the regulatory considerations, many people will hear the words that disclosure cures all. But the problem with disclosure is that, and I think we started out the webinar with a statement to this effect, co-investments are an evolving environment. We haven't seen many of them 10 years ago. We're seeing a lot of them today. And now the regulators will end up looking at them 3, 4, 5 years from now, maybe 2, maybe 3, maybe 4, maybe 5 years from now. There's no limit on how far they can go back, although the usual is probably around 3 years. So what you're trying to do today is estimate what will resolve a regulator's concern in the future. Top concern listed in the priorities in both 2015 and 14 were conflicts of interest. Conflicts of interest abound in co-investment, whether you're structured as an SPV or you're structured as a direct investment in the portfolio company. It was apparent in the statistics early on about where you find your co-investments. They're in LPs, that your existing LP base. They're in LPs that you want to get into your LP base, and they are referrals from your existing LPs. And the SEC is certainly concerned about that inducement of offering co-investment opportunities to people in order to get them to invest, or the prospect of offering a co-investment in order to have them invest in the next fund. Just the very act of trying to build that relationship, and co-investment is an excellent way to do that, to see if you want to partner together for the life of the whole fund the next time you raise a fund. That very inducement is one of the conflicts that the SEC is worried about. Other places that conflicts come about, we've touched on a number of them already. You've got a co-investment which sits side by side. There's a small group of investors in the co-investment vehicle. There's a large group of investors and a diverse portfolio in the fund. How you act as a manager relative to the diverse portfolio versus the single investment raises fiduciary issues which can give rise to a conflict of interest. How you allocate investment opportunities or plan to allocate them among your LPs can give rise to a conflict of interest. That one's actually relatively easy to resolve through disclosures. If you have a policy about how you're going to make investment opportunities available, and I would highly recommend that you would have that policy in writing, it's a policy that can evolve over time, and if you aberrate from it, you can certainly modify your policy and keep reviewing it and keep making it closer and closer to your actual practice. But having that policy in advance is a huge protection to the manager from both regulatory scrutiny and fiduciary issues relative to investors. Now, this always comes up when an investor gets unhappy. An investor gets unhappy, something gets triggered, the SEC comes in and takes a look, and they look at everything in hindsight. That hindsight, the proverbial cliche goes, is 20/20. And they are approaching it often with the view that somebody's unhappy, something must have been done wrong, and therefore you're in the soup before you're proving that you're not, that you did everything right. I don't want to say you're guilty before you're proven innocent, because I don't think it goes that far, but I do think that there's a taint to it that comes along with that ability of a regulator to look at things with hindsight. So they're testing that conflict of interest, they're testing whether you made the adequate disclosure, and they're, again, looking at it in hindsight. And they're looking at how you dealt with the investment all along while you held it. So if you have an opportunity for a down round or an up round, particularly acute in a down round if the portfolio company is not going that well, or is taking a dip before it gets the ramp up, then you have different sets of concerns in the group. And I think there was some commentary earlier about preordaining the obligation to fund follow-on rounds and having penalties if you don't. That's a good idea. Establishing it contractually means it takes away some of that decision-making at the time, alleviating the fiduciary and conflict of interest concerns. Again, the disclosure and the contractual commitment being very clear up front goes a long way to alleviating that. I'll stop here and let Jason and Michael and John comment on anything that they want to add to the conflict of interest or the allocation of investment opportunities discussion.
Actually, you know what? I'd like to pop in for a second because we had a great question come in about 5 minutes ago relating to expenses. Question reads as follows. The SEC has clarified that managers need to disclose how co-investment expenses, including broken deal fees, are allocated. What do you guys think is the, quote, right allocation? 100% of expenses to the main fund may not be ideal to the LPs of the fund.
Well, I'll address that first and then turn it over to the people in the real industry. There's a lot more fees and expenses discussion that goes with co-investments than just broken deal expenses. I'll address that one first and then we can dispense with it. If you are a co-investment fund, you're going to bear some broken deal expenses. If you are a co-investor who's coming in, if the deal closes, there isn't a broken deal expense. So the question becomes, what happens if you haven't formed your SPV, you don't know it's going to close, but the fund has some expenses and the deal busts? I've heard different industry practices on this. One is to just say that's a fund expense. If you are punching above your weight, as John put it earlier, having that full fund expense there may be something you need to disclose in your PPM because you are dealing with a larger deal. I think Bruce will tell you the expenses of any deal, it doesn't vary that much by the size of the deal, so maybe the broken deal expenses are actually appropriately fund expenses regardless of the size of the deal.
Right.
Another way people sometimes deal with that is there's risk in having the broken deal expenses being the fund's responsibility, as you would have disclosed in your PPM, and therefore if you close a co-investment vehicle, sometimes, and I was surprised to learn this recently, sometimes, and I did not learn that from the people on this panel. This was another conference I was attending. I was asking people this question, and several people answered that they would have the co-investment fund, or co-investment vehicle, pay a fee if the deal closed in order to compensate the fund for risk. In their case, it was a 1% fee, 1% of the amount that was in the co-investment SPV. If the deal closed, was it actually paid over to the fund to compensate it for taking that risk, and they had disclosed that in their PPM. But most of the time, the fund bears the broken deal expenses unless there is some pre-existing vehicle to which they should have been allocated in addition, because that pre-existing vehicle would have participated in the investment. As to the other kinds of fees and expenses, transaction fees, clearly, and by that I mean the lawyers, the accountants, the consultants, the environmental, the valuation, the executive comp, whatever consultants you're using in the deal, those expenses of the deal should be allocated between the co-investment vehicle and the fund. And we don't have a percentage on this in the data, I don't think, Bruce, outside the slide, whether you do, but I would say it's probably 99% going to be based upon the amount of the capital invested in the portfolio company. So that one's pretty easy. Ongoing expenses of keeping the co-investment vehicle. So you have an audit requirement. There's a couple tens of thousands of dollars a year to audit the co-investment vehicle. That usually is borne by the co-investment vehicle. There is some argument to say that you aggregate these co-investment specific operating expenses and the fund's operating expenses and pull them into one pool and then allocate them based upon invested capital or some formula that you have disclosed in advance. But I would say most people would look at co-investment vehicle specific expenses like audit and allocate them to the investors in that co-investment vehicle. So I'll pause there and ask for John, Michael, and Jason, thank you, to comment on how they expect and experience expenses of operating a co-investment vehicle to be borne.
This is Mike at Peak. To date, we don't have one. We may in the future.
Well, we've had vehicles. Everything that Julie says, I'm sort of on board. I think is accurate and exactly the way things play out. And she said that there's a number of ways to handle the upfront broken deal costs of the fee, which I think is the main question that was asked. And what I would say is I don't think it's practical. Look, we're a lead investor. We're driving the deals. We're going to be in charge of the deal. Whether we're going to buy a company and put $15 million of our capital into the deal or $35 million of our capital in the deal, and whether or not we're asking for $5 million of co-investment or $30 million of co-investment, it's an investment that we're working on behalf of our investors in order to deploy capital to fund and provide a great return. And so the practical reality is you don't really know who your co-investors are going to be. Are they going to be your own LPs? They're going to be outsiders? They're going to be other people? You may have a deal with another private equity firm or another outside LP to say, you're far enough down the road, let's tie together and let's share the expenses if there's a broken deal cost. And that may be their price to continue forward, all right? But the reality is, the practical reality is, we're driving the deal, and so ultimately the broken deal costs would, if it occurs, would end up being a fund expense. And as Julie alluded to, typically those deal costs are going to be the same regardless of the size of the deal typically. So I just don't know if there's a practical way to do it otherwise. I mean, I think because your co-investors haven't committed to the deal up front unless it's a co-investment fund. If that's the case that you alluded to, then you can charge a co-investment fund that you're in control of a piece of those costs. But if there's a sort of a pre-apportionment agreement in advance, like 2/3 of the fund money and 1/3 of the co-investment fund. But otherwise, I think if you're leading a deal, you're going to have to, bear the brunt. Your LPs are going to have to bear the brunt of the broken deal costs.
And one of the things the SEC would say to you, and they've said this in a couple of enforcement actions, is that disclosure of that fact will cure any issue about it. So you have to disclose when you're writing the PPM, which of course is 5 or 7 or 8 years before you're actually dealing with a certain expense. And that's very difficult to have the crystal ball. But if you do make the disclosures and you say the fund is going to bear that expense, then the SEC, your regulator, really has nothing to complain about.
With regards to the other, the conflicts of interest, the disclosures about, the allocation and all those things that Julie brought up, and Mike can talk a little about being, having a good, solid process in place that you can look back on and say, look, we went through our process, this is how we do it, and you've disclosed that to your LPs. But, the one comment is, things are changing in the marketplace, so you got to be very thoughtful about, how you're managing co-investment opportunities. I think Warren Buffett said that, if you follow, I don't care who you are, if a police officer follows you for 300 miles, he's going to find something you did wrong. And the whole idea of, looking back in hindsight as to the how things were doled out in a co-investment opportunity was a hugely successful deal. Why wasn't I called? I think the most important thing is that I said really early on, forgetting about all the process, if your primary obligation in building out an investment group for a deal is driving that investment to be the most successful investment it can be for your LPs in the general fund, that's your primary obligation. If you stick to that that premise in terms of how you initially allocate whatever the co-invest is, once you determine that you from a risk perspective, you don't want to take on the whole deal, or there's excess capital, your first premise is, can I bring someone in who's going to help drive value? Then you go to the next step. Well, what are my obligations to my LPs to give them the opportunity to invest, fulfill those obligations, and then you sort of move down the line, and you have a process in place to document that, and you try to be really consistent and really transparent and really honest. I mean, the technical pieces of it and the real specifics are really developing, and Mike can talk a little bit about that. But I think if you just, if you fundamentally recognize what your true fiduciary duties are to your investors and you stick to that, I think you'll ultimately be in a good position.
And, Julie said you have to have a policy where you have to make sure that you could prove you're following the policy. And the way that we did it is we built the whole co-investment process right into our deal flow, fundraising, CRM system. So, if any time we can prove that we had this co-investment opportunity, we showed it to these people, this is who we talked to, when we talked to them, this is why they decided to proceed. So we hope that by doing that, we make sure we're covering ourselves for somebody looking at what we're doing now. Yeah, years from now.
Milestone does it the same way. I mean, we literally will put together the materials. We'll log exactly who we talked to, why we talked to them, why they passed. We go through an entire process. If it's a certain size, we won't go and talk to investors of a certain size below a certain amount. I mean, we've limited the rights to our LPs to get co-investment, so that there are fewer sort of obligations for us to show opportunities to the fund, although we want to do that. And Jason will tell you that, sometimes having the contractual right isn't all it's cracked up to be, because the rest of the investors have the contractual right, then it becomes a complete mess trying to sort of figure out who gets the co-investment opportunity. So in Jason's case, in Siguler Guff's case, they're not looking necessarily for contractual right in some cases, because if they have a good enough relationship, they know that they're perceived as a value-added investor that responds on a timely basis and is supportive of the deals. That puts you in a better position than having a contractual right.
Well, guys, I hate to break it to you. It is 12:59. I knew that we could do this for hours on end. We did have 1 or 2 questions that we didn't have a chance to get to. Brian, I don't know how much flexibility we have on time, but I figure we should stick to the schedule.
Yeah, this is Brian. two things. I did want to give the fourth CLE word for folks that are interested in that, since we are at the hour mark. But then we can go over a couple minutes, and Julie had a couple more points to make. And if you did have questions, feel free to still send them in, and if we don't address them here, we'll get back to you offline. So if you had a question or two that you're interested in, feel free to send them in. We'll save them and get to you offline. The fourth code word is going to be, private. So private is the fourth code word. Feel free to email me for that form. Feel free to email me for the study that we've been talking about for the last hour, and then I'm going to turn it over to Julie for a couple more minutes.
Just a couple of final points on the regulatory issues that we find are sometimes overlooked just because you're not focused on the regulatory aspect when you're putting a deal together. So a co-investment vehicle, a special purpose vehicle, is a separate client. For the custody rules, it requires a separate audit. It would count if you are an exempt reporting advisor and you're trying to stay outside of state requirements, it would count as a separate client. So just keep those things in mind, and that the SPV needs to abide by the custody rule just like your fund does. And the second thing that often catches people by surprise is the co-investor base needs to be tested for the 25% plan asset rule, just like your fund does. And to the extent that you end up with ERISA responsibilities in the co-investment vehicle, keep in mind that the Department of Labor is just put into the OMB a new fiduciary duty rule. It's all of 900 pages long. The length of it is in the exemptions more than in the rule itself. And it's unclear yet how that affects the private equity industry, except it does throw a little bit of quandary into the fiduciary duties that you owe for ERISA plan assets. So just don't want anybody to get caught unawares by that. The process, as I mentioned earlier in the regulatory remarks, process and disclosures cures a lot of regulatory concerns with co-investment vehicles. And to the extent that you can preordain what you are going to do and you disclose that preordained process, that is a wonderful remedy for any problems. So I'll turn it back over to Brian and Claudia.
We actually did have a couple questions. I don't know if you guys can maybe quickly try and take one, but one of the original ones that we had, kind of shifting it back to the transaction. Brian, if we could go to slide 23, that would be great.
All right.
So on that slide, we'll look at the statistics, and the question was as follows. 34% of co-invests are carry-free and 14% are reduced carry per our study. One of our listeners wanted to know, does that mean that 52% are full carry? Similar question on the management fees.
Yeah, this is Bruce. Presumably, yes. I mean, I would read the survey literally. I would read it that way as well. But as we discussed, for example, with the tag-along and drag-alongs, in 25 years, I can count maybe less than a handful of deals I've done without a drag. And I don't think I've ever done, like John and Jason were talking earlier, I don't think I've ever done a tag without a drag or a drag without a tag. So I mean, the way I've had obviously a lot more time than our participants to pour through the survey. The way I've been using the results is not absolute numbers as much as kind of a preponderance of likeliness to occur. So the items on the right seem less important in the negotiations versus the items on the left. So I think the math is clear, but if I would kind of ignore the math and say that generally speaking, the parties, the LPs and GPs are typically including the deal terms on the left twice as much as they're negotiating the deal terms on the right of the slide, that kind of thing, as opposed to drawing a mathematical line and saying 52% of deals are full carry, although, again, I fully admit that that's what the data suggests.
Understood. And then quickly, maybe, Julie, you can address this one. It was one of our later questions. Do MFN provisions in side letters typically also apply to getting looks at co-invest opportunities?
The whole issue of side letters and co-investments seems to be taking off like a jet plane. I think the minimum is that the side letter that somebody negotiates for the fund will extend to your co-investment vehicle. In addition, what we're seeing is people come into the co-investment and they expect additional side letter provisions, which are tied to the fact that it's a single portfolio investment, that it's a special purpose vehicle. It might try to add incremental opportunities to for co-investments, or address the specific tax attributes of the portfolio company. So there might be a foreign aspect which wasn't necessarily a concern to them in the fund, but they will have that concern if it's in the SPV. So I think the general answer is yes, the MFN that you negotiate for your fund side letter is going to be an MFN that you have for the co-investment vehicle, generally.
I think that pretty much is going to bring us to a good point for a full stop. There were maybe one or two questions that we didn't get a chance to address, but as Brian mentioned, they will be followed up with subsequent to the webinar completing. So I will be the first to say thank you very much for joining us. Thank you to our panel of experts for taking the time off and giving us insight from various perspectives into this evolving and new-ish world of co-investments. So I will turn it over back to Bruce. I'm sure he'll have a few parting words.
All right, well, for those of you who want CLE, don't forget to email Brian, and don't forget to download the survey. We will, as Brian and Claudia said, respond to the questions that weren't answered offline. A special thanks to Jason and John and Mike, and to my co-panelist, Julie, and thanks to all of you participants for participating.
Thank you, Bruce.